Thanks for taking some time out of your day to check out this video from NetPicks. And I'm going to talk about this indicator called the Coppock Curve indicator. And I find the backstory behind it quite interesting. Now, it uses the period settings of 11 and 14 in months. Okay. Those numbers, according to the developer, his name was Edwin Coppock, that was the average mourning period in months for those who were grieving the loss of a loved one between 11 and 14 months. Now, he believed that that mourning period is roughly the same when people are looking for a recovery in a stock market. Now, the indicator originally was designed to show buying opportunities in the S&P 500 and the Dow. And like with most indicators, as time goes on, traders begin to adapt it to other markets. They use other techniques with it. That's what we're going to talk about. Now, the Coppock indicator it's a smooth momentum indicator that traders are using on any time frame as opposed to just the monthly chart. And all it is a weighted moving average of a rate of change indicator calculation. So by using the weighted moving average, that most recent data is given more weight than data in the past. Now, can you change those default settings? Like with most indicators, you can adjust the settings to make it more sensitive, to make it less sensitive. But really, that's not always a good use of your time because the combinations that you can use are pretty endless. So I just think keeping the original settings and then spend your time developing a strategy around it, that's probably a better route for most of you. So let's talk about the trading signals. So a buy signal is when the Coppock curve line breaks above the zero line. A sell is the exact opposite when the line breaks below zero. So for this example, we'll use a monthly chart of Walmart. And over the course of 8 years, we get 5 trading signals as shown by those vertical lines. So when the Coppock goes green, it just means we've crossed the zero line. That's a buy. When we see red, it's time to exit your position and or initiate a sell. Now, 5 trades in 8 years. Monthly chart's probably not the best for trading, but you could certainly use it for a macro view of the trend. Now, just keep in mind, okay, it's just an indicator. Okay, there's nothing overly special about the original time period. So let's take a look at a daily chart of Costco. This is 12 months and there's quite a bit of action, but overall, and not including the current move, the results really are not that impressive. Now remember, we're just talking about taking the crosses of the zero line as trading signals, right? When to buy it, when to sell. And generally, regardless of any trading indicator you're using, trading a crossover, generally it's not the best approach. And I say generally because there will be exceptions. So let's try one last time. We're going to use an intraday time frame to see if that crossover of the zero line is viable. This is a 15-minute chart of MHK. And remember, green, we buy, red, we sell. Not impressive. There's a few false signals. However, this is just really one snapshot in time, right? Other days might look better. And a further deep dive into this may be something you want to do, but to save you some time with this, is probably not going to yield great results just trading the crosses. But another way you can use this indicator is through a 2-step process. Number 1, find the trend on the higher time frame. Second, trade the zero line breaks on the lower time frame. So what does that look like? This is 30-minute time frame. It's a stock chart, the same one we just used. But this time I want you to notice a small inset chart here. That's the daily time frame. It shows the indicator is green. It's above zero. It's buys. Right? So that means on the lower time frames, we only look for trade signals to buy. So here's a general plan. The indicator crosses from red to green. The buy trade is entered on the close of the candle, right? Or whatever time period you're using. Set an initial stop using ATR of 2 to 3 times the ATR. And exit when the indicator crosses and closes below the zero line. Okay? We need price to close. So what we're doing is you're using the power of the higher time frame trend along with the ebb and flow of price on the lower time frame to trade. Let's look at using weekly charts for the trend and daily charts for signals. Okay, this can be more for a longer term trader. So if we zoom out and use the weekly trend and daily signals, does it do much better? Let's check it out. Uptrend. Okay, the ATR We're going to use that for the stop loss. And upon trade entry, we're going to use it to set our initial stops at 2 times the ATR. Okay, this is a daily stock chart, Mid-America Apartment Communities. Okay, its ticker is MAA. And the weekly trend is up. So as you can see on the left side of the chart, there are some small losses. Okay, the ATR does help minimize the losses because at times your stop using the ATR will trigger before you'll see the cross on the Coppock curve. Now there is one good section on this chart. On the right here, ran for about 11% increase. Still, to be honest, I would not risk my capital on the crosses of this indicator. Yeah, you can play around with the inputs, make it more sensitive or less, but as I talked about earlier, that's just a rabbit hole. It's kind of a waste of time. What about trend and price? So let's use it for trend determination and just simple bull flags or bear flags, right? Essentially pullbacks as an approach. This is a daily chart of Euro futures. So all we're using is simple chart patterns, right? Flags, channels, ascending triangles, breakouts, pullbacks, all those in the direction of the trend. Now this is something I can actually get behind as a trader, and it highlights why a technical indicator cannot replace price action by itself, okay? There are some good trade entries here that are much better than what the crosses would give you. Okay, so I want you to think about these ideas. We can use it for a simple way to determine our trend direction. We can enter in the direction of that trend via price patterns and exit via the change in trend by crossing zero if you like. We can use profit targets. We can trail our stop under our lows using our ATR reading. And this is pretty close to naked trading, quote, naked trading, right? Where the only difference is you're using the indicator for trend. Divergence, and this is the last one I want to take a look at. Now, since it's an oscillator, and that's what we use for divergence, we can see how it performs in this manner. Take a look here. This is a 1-hour chart of Euro futures. Price is moving down while the indicator is red. Price makes lower lows. The indicator makes a higher high. Now, traders will start to consider a trade entry, even though it's a downtrend. Okay, but we have a rising Coppock curve. Number 2, price makes a higher low. The indicator dips to red, puts in a lower low. So while price does rally here, it doesn't make new highs. And then it does go into a multi-day range. So using the indicator for divergence, that's not a bad tool. So if you're looking to develop a trading strategy, you might want to consider higher time frame trends along with price patterns and divergence on lower time frames. So to wrap it up, the idea behind the Coppock curve is interesting, but by itself, it's not an edge. As a trend indicator, it does what it's supposed to do. And you could certainly use multiple time frames as a trading approach with the Coppock on a higher period for trend determination. To give buy or sell signals, I would take a pass on it. I would rely on several chart patterns to do that. Now, you could add another technical indicator, but if you do, just make sure it's not a redundant indicator, right? Like you don't need 2 oscillators. Now consider experimenting with a moving average for trend and the Coppock curve for trading triggers. I didn't cover that at all, but it's something that you could experiment with. Now, what about divergence and trend direction? Experiment with that. I did not do an exhaustive test here, obviously. That approach could have some merit. But my pick for the bones of a trading strategy would be using price patterns along with trend determination and divergence. And as always, proper risk protocols must be in place before you place any trades. All right, appreciate you taking the time to watch the video. Hope you hit like, subscribe to our channel. Any questions or comments, put them below. And we'll see you again.